I'm John Hanna for CDTV.net in New York, and we have Dirk Van Dyke, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio. Hey, Dirk, how you doing?
Oh, not too bad, John. How about yourself?
Great, great, great. I'm actually on your website at Zacks.com. I'm gonna be looking at the home prices keeps falling, right? That's the one you want me to check out on your
Yes.
homepage. Okay, I'm there now. Well, let's talk about these home prices.
Yeah, well, we're still in a downtrend in housing prices. We had a bit of a bounce from sort of the spring of 2009 to mid 2010, but since then, after the home builder tax credit dried up, so did housing prices. And using the seasonally adjusted Case-Shiller numbers. And this is an important point because most of the press gets it wrong and uses the unadjusted numbers. But there is a distinct seasonal pattern to home prices. So looking at the seasonally adjusted numbers makes more sense. But home prices in January were down 0.22% on both the Composite 20 and the Composite 10 indexes. The Composite 10 is a subset of the Composite 20, but has a much longer history. Year over year, the 10 cities, which tend to be the bigger cities, were down 2.03%, and the 20 were down 3.03. But if you look at the long-term picture, since the decline from the peak back in April of 06, both are down about 31%, 31.44 for the Composite 10 and 31.3 for the Composite 20. This is a pretty rough situation going on here. The stabilization that we saw in housing prices was a very hopeful sign, but now it's all sort of drying up. A little bit of a hopeful sign in that the declines were not as broad-based as we've seen in recent months. We actually had 8 cities that were up and 12 down. If you look at last month and the month before, it was more like 3 cities up and 17 down. So that is a little bit of a hopeful sign. But when you look at a situation where there are over 11 million homeowners with mortgages that are underwater, this just falling home prices pushes more and more people underwater. I mean, it's about a quarter of all homeowners with mortgages now owe more on their homes than the homes are worth. And that's a necessary but not sufficient condition for foreclosures to happen. And so the more home prices fall, the more we're going to have a foreclosure problem. Housing is also the major wealth repository for the vast number of Americans. Unlike the stock market, where wealth tends to be very concentrated at the top of the pyramid, housing wealth is, or at least before it all dried up, was a much more democratic form of wealth. And on a year-over-year basis, there are only 2 cities that are up and 18 that are down. The 2 cities that are up is Washington, D.C., which is up 3.59% from a year ago, and then San Diego, which is only barely up 0.08%. Now, as recently as July, San Diego was up 9.5% year over year. So you're definitely seeing that started to fade as well. So next month we'll probably be down to just Washington, D.C. as a city where prices are up year over year. We've got a total of 8 cities where prices are down more than 6.5% year over year. And, when you think about housing is a very leveraged asset, right? with the stock market, if you're really going for it and using maximum margin, well, you're putting up half the money, right? And you're margining 50 of it. In housing, if you're pretty conservative when you buy a house, you only put 20% down and borrow 80%. So if you got housing prices that are falling 6, 7, 8%, or in the case of Phoenix, down 9.15, which is the largest year-over-year decline, that's going to wipe out, half of your housing equity if you had bought with 20% down, or almost half of it. That's a real problem, and you're pushing more and more people underwater, where it just makes sense for them to simply walk away from their houses. From the peak, things are really rather horrific. We've got two cities, Las Vegas and Phoenix, which are down more than 55%, and another three cities, Miami, Tampa, and Detroit, where prices are down more than 45%. That means that, a huge number of people in those cities are underwater, and you really would have had to have bought in those cities, decades ago to have made any money on your house. So, but we still have, a huge problem with too much inventories out there. We saw in the existing home sales that the month's supply had jumped back up to 8.6 months. Back in the bumble days, I was running around 4 months. And in a normal, healthy market, you want to be around 6 months. And that doesn't really even count all the shadow supply, the people who, instead of waiting and saying, well, this isn't a good time to sell the house, I'd really like to get out of this old white elephant, but I'm not going to sell now. But it's looking more and more like it's a process of waiting for Godot. I mean, it's just not going to come anytime soon. And eventually those people start putting their houses on the market because they're not going to wait another decade to be able to sell. And you have all the foreclosures coming on. What that does is it undercuts the prices of new homes, right? People, existing homes are very good substitutes for new homes. And that means that fewer new homes are sold and thus built. And we're at an all-time record low for new home sales. Those records go back to 1963. And of the last 10 months, they are the 10 lowest months for new home sales. And, last month was the all-time low. Now, the level of existing home sales really doesn't matter that much to the economy. But new home sales are absolutely vital, right? Because each new home sale, each home being built, think of all the concrete and wallboard and lumber and labor that goes into building a new house, right? Those are, and all those jobs, right? People have money to spend, and because they're working, and they go out and spend it in the economy, and that creates still further jobs. And historically, every recovery has been driven by an increase in residential investment. It's just not happening this time around. And that is the reason, the principal reason that this has been such a weak recovery. We simply have too many homes out there, and with very high unemployment, it means we don't have a very good rate of household formation. Instead of economists speak for getting junior out of mom and dad's basement and into a place of their own. We've started to see a little bit of that happening, mostly moving into the rental market, into apartments where the vacancy rate has started to come down, but it's still very, very high. Eventually that will spill out into the home sales, but it's going to take a while to happen. I mean, we still have a growing population, and eventually, junior is going to move out of mom and dad's basement. But To do that, you need a job. You need a stable enough income that you feel confident to do that. That sets up a really nasty chicken and the egg situation, because historically, construction has provided a lot of those jobs coming out of recessions. Construction has been absolutely decimated. It's accounted for 1 out of 4 jobs that have been lost in this recession, right? And that's just the direct jobs that are lost in construction. That doesn't count the lumberjacks that aren't cutting the lumber. Doesn't count the factory that's producing the wallboard or the plumbing fixtures or any of that stuff. So you add all that stuff in, you're probably up to about 40% of the jobs lost are directly or indirectly related to the housing, and fairly directly, indirectly, i.e., producing the lumber. That is very hard to produce a lot of those jobs, and therefore you don't have the household formation levels, and therefore you don't have the demand for housing. Nasty, nasty, nasty chicken and the egg situation. In the meanwhile, everybody's wealth is getting decimated by housing prices falling. And that's wealth that wasn't really going to be some great plutocratic formation of a foundation or anything like that. That is wealth that people pretty much had plans for, right? They were going to borrow against the home to finance the kids' education. They were going to sell that house and then, use the money to move to a cheaper place and retire, right? That's not going to happen anymore. So presumably, people will still want to send their kids to college. They'll still want to retire at some point. And to do that, they're going to have to save the old-fashioned way, like spend less than they earn. And in that process, you end up slowing down the economy. So you've got a situation where millions and millions of people are getting demonstrably poorer because housing prices are going down, and therefore they have to save more, and they're going to be less willing to spend. That, again, is a major drag on the economy. It's actually rather remarkable that in the absence of anything going on in residential investment, we have a fairly strong economy. I mean, growing 3.1% in the fourth quarter, not all bad. That's about a normal growth rate with, one of the main locomotives that's supposed to be pulling things totally derailed. So, now the bright side, if you want to pull up that final graph on there, is that the housing prices are not going, we're not going to have a repeat of what we had from the spring of '06 to the spring of 2009, where housing prices plummeted by over 30%. That prices simply were so ridiculously high relative to rents and incomes back then that there was just huge room for prices to collapse, right? Because after all, a house is an asset, right? And the value of an asset is going to be the discounted flow of all the cash flows you receive from that asset, from now until the end of time, or until at least you sell the house. Well, what are the cash flows from owning a house? It's the fact that you don't have to pay rent. So if house prices get really, really high relative to rents, people say, why am I buying this? This doesn't make any sense. I'll just rent instead. If housing prices fall relative to rents, then people say, it would be really nice to have a place of my own, and I don't have to deal with a landlord and all that stuff, and they'll move into buying houses. prices now relative to rent are back within the normal historical range. Right? They are not cheap by historical measures, but they are kind of more normally priced. I think that holds the decline over the course of this year to, maybe we go down another 5% from here, not another 30%. But 5% on a heavily leveraged asset where people are already underwater is just makes it much more likely that you can have more foreclosures, right? Because it's not just the bright line of being underwater. Yeah, that's important because anytime you're above that, it really is economically irrational to let the bank foreclose, right? But you're not necessarily going to say, I'm going to walk away from my house because, it's worth $149,000 and the mortgage is $150,000. Right? You still like the kids like their schools, all their friends are there. It's going to be a hit to your credit score. For $1,000, that's not really worth it. Now, what if you have that same mortgage of $150,000, but the house is only worth $75,000? Well, in that case, you got to be really, really stupid to continue to pay that mortgage, because in effect you have an option to sell that house for $150,000 simply by stopping to pay the mortgage. All right, the bank takes over the house, you take a hit to your credit score, but for $75,000, that's worth a couple of points on your FICO score. So the further you push somebody underwater, the more likely you're just going to say, to heck with it and, stop paying your mortgage. That means more houses come onto the market and you get this self-perpetuating downward spiral in housing prices. Until prices get low enough that everybody who's renting says, why am I paying $700 a month for this crappy, one-bedroom apartment when I could have a nice 3-bedroom house that I would own and I wouldn't have to deal with a landlord. We are getting closer to that point. We're not really there yet, but I think it's going to happen. That's going to cushion the further decline in housing prices. But the trend is still down, and we really need to see that stabilize to get the economy healthy again. Once that starts to happen, we'll go from a vicious cycle to a virtuous cycle. Right? New home sales will start to pick up. That means that there'll be more houses built. That's more jobs. That's more people with the income to buy houses. And you start climbing back up into a virtuous cycle. We're not there yet, but we've started to see some improvement in jobs, not coming from the construction sector, but more from the manufacturing and service sides of the economy. So slowly that's starting to change the picture, but not yet. But it's coming. So I don't want to get totally alarmist saying we've got a repeat of the housing collapse, but we do have a gradual erosion in housing prices, which is putting a lot of pressure on people's wealth. That's going to slow spending, cause savings rates to increase, and slow the economy. But inherently, I think the process is limited to another 5, at the outside, maybe 10% if there's some additional bad news elsewhere that slows things down. And there's certainly potential for that, given all the events going on in the Middle East and Japan and things like that. But by and large, we're getting closer to the bottom on housing prices, but we're not there yet.
That's Derek Van Dyke, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio, and I'm John Hanna for CDTV.net in New York.